through realization account. Through realization account. Only in a situation where problem specifies that entire business is taken over by the purchasing company, or including cash and bank balance is taken over by the purchasing company. Note 3. We should not close miscellaneous expenditure at to be written off and the profit and loss debit balance through realization account. As they are known losses, we should close both of them. Through equity shareholders account. By passing the following journal entry. That is, equity shareholders account debtor to miscellaneous expenditure to profit and loss debit balance. Next point. Closure of liabilities. All the liabilities to the outsiders needs to be closed by passing the following journal entry. Liabilities account debtor to realization account. Note, such a closure need to be made only at the book value. Closure of reserves. Reserves represent undistributed profits. Reserves represents undistributed profits, and they belong to the equity shareholders. And accordingly should be closed through equity shareholders account. Journal entry, reserves account debtor to equity shareholders account. Accounted to equity shareholders accounts. Closure of preference share capital. Journal entry, preference share capital account debtor to preference shareholders. Closure of equity share capital. Journal entry, equity share capital account debtor to equity share holders account. Next, accounting for purchase consideration. Purchasing company account debtor to realization account. Next, accounting for the sale proceeds. Of those assets not taken over by the purchasing company. Cash oblique bank account debtor to realization account. Students, here you should keep in your mind that as the asset got closed against the realization account, the sale proceeds of such asset is getting accounted through the realization account. Next, discharge of liabilities not taken over by the purchasing company. Journal entry, realization account debtor to cash oblique bank. Receipt of purchase consideration. What need to happen? Purchasing company's account is to be closed. How we are passing the journal entry? What we are going to get, we will debit, and ultimately we will close the purchasing company account. What we are going to get, either the equity share capital or the preference share capital or the debentures or the cash. So, pass the journal entry. Cash account debtor, bank account debtor, equity share capital in the purchasing company account debtor, preference share capital in the purchasing company account debtor, to purchasing company. With this, what we did, we closed the purchasing company account and we are accounting for the assets which we received from the purchasing company. Then realization expenses. Side heading, realization expenses. Journal entry, realization account debtor to cash. Of course, friends, here as already stated in our earlier session, realization expenses, what could be the possibility? Like some of the realization expenses or the liquidation expenses of the vendor company may be reimbursed by the purchasing company, in which case the probable entries could be like realization expense accounted to cash whenever vendor company meets the expenditure, and when it gets the reimbursement, it can very well write the entry cash accounted to realization expenses. And in case if there is any difference, like vendor company spent 15,000 rupees on realization expenses, whereas purchasing company only reimbursed 10,000, there will be a balance in the realization expense, which realization expense account balance will be closed through the realization account. Other way around, in a normal course, when liquidation expenses are met by the vendor company itself, simple entry that need to be passed is realization accounted to cash. Then discharge of preference shareholders. Discharge of preference shareholders. Preference share capital account data, preference shareholders account data, preference shareholders account data to cash, to bank, to preference share capital, to preference share capital in purchasing company. Here students, first you should take care while doing the problem when there is presence of preference share capital, what type of care that we are expected to take. Point here is, in case if the preference shareholders are going to get more than what the outstanding amount they got, then for them it is a profit, for the company it is a loss. In case if they are going to get less than what they are holding, for the company it is a profit, for them it is a loss. So necessarily you should check whether preference shareholders are getting exactly what need to be paid to them, or are they getting a more, or are they getting a less. We don't have any problem once they are getting exactly what the outstanding amount for them. In case if they are getting a more, then to that extent realization account is to be debited, preference shareholders account is to be credited. In case if they are getting a less, then preference shareholders account is to be debited and realization account is to be credited. And the point that should go into your mind is, when there are preference shareholders or the preference share capital, without discharging the preference shareholders, you don't close the realization account. Because if you do like that, what will happen? Preference shareholders account will not get closed. If you are paying more than what their outstanding balance is, then your preference shareholders account will not get closed, and unnecessarily the loss or profit which otherwise belongs to the preference shareholders will go to the equity shareholders. So this point should necessarily be kept in mind. So write down, in case if the preference shareholders are paid more than their outstanding balance, then we need to pass the following journal entry. For such excess amount, we need to pass the following journal entry for such excess amount. that is preference realization account data to preference shareholders accounts, and in case if they are getting a less, in case if they are getting a less, then the entry will be preference shareholders account data to realization account. Next, accounting for ultimate profit or loss on account of realization. Realization account data to equity shareholders account. Being the profit on realization transferred to equity shareholders account. Being profit on realization transferred to equity shareholders account. In case of loss on account of realization, entry is equity shareholders account data to realization account. Then finally we need to discharge the equity shareholders. How do we discharge the equity shareholders? Write down entry to discharge the equity shareholders. Equity shareholders account data to cash to bank to equity share capital in purchasing company. Friends, try to understand one point. What all the exercise that we did so far by discussing and by your writing all the journal entries, this is all aimed at what? Just to tell you the procedure. In the practical problems which you are going to face in the practical life or in the examination also, few more situations you might come across, for which with the basic knowledge of accounting which you have, I am confident you can very well pass the entries. But what the entries that we studied so far are the minimum entries whenever you need to close the books of accounts of the vendor company. Now take the notes on accounting into the books of the purchasing company. Accounting in the books of purchasing company. In fact, accounting in the books of the purchasing company is very simple. In what way? There are only 4 entries. One is to account for purchase consideration. Another is to incorporate the assets and liabilities of the vendor company into purchasing company books. Third is a discharge of the purchase consideration. Fourth is to account for the liquidation expenses of the vendor company met by the purchasing company. Of course, significantly, as far as accounting is concerned, how it is going to make a difference once it is a merger and once it is a purchase. What I am looking at here is probably the difference is here. Like in case of purchase, you are going to account for the difference between the purchase consideration and the net assets taken over either as goodwill or the capital reserve accordingly. Whereas such situation will not be there in case of amalgamation in the nature of the merger. There what you are going to do is what they are getting and what they are holding in their company, that difference after incorporating all the reserves of the vendor company into the books of the purchasing company, you will accordingly debit the general reserve or credit the general reserve. And one more important observation that we need to make is, in case of amalgamation in the nature of the purchase, assets and liabilities will be incorporated only at their taken over values. In case if it is a merger, you are going to incorporate them only at their book values. And one more difference could be, in case of amalgamation in the nature of the merger, you are going to incorporate all the reserves of the vendor company into the books of purchasing company through journal, whereas in case of purchase, you are not going to incorporate their reserves. Of course, in case of the purchase, we don't get into such kind of problem in the case of the merger because all the reserves are getting incorporated here. In case of the purchase, since reserves will not be incorporated here, if any reserve which required to be statutorily maintained is to be carried by the purchasing company subsequent to the amalgamation, then they have to pass an entry amalgamation adjustment account debtor to statutory reserve. With these differences, the journal entries to be passed generally, we need to now discuss on. Take the point. First, accounting for purchase consideration, accounting for purchase consideration, journal entry, business purchase account debtor to, business purchase account debtor to, liquidators of vendor company to liquidators of vendor company. This entry is to be passed with what amount? Purchase consideration. Incorporation of assets and liabilities of the vendor company into the books of purchasing company. Entry is assets account debtor to liabilities to business purchase. Through first entry, what you did, you debited the business purchase account. Now with the incorporation of the assets and liabilities, that business purchase account requires a closure. So on that pretext, you are crediting the business purchase account. Once the assets and liabilities of the vendor company are incorporated into the books of the purchasing company, the business purchase account will get closed. Now the third issue is what? How do you close the liquidators of the vendor company account? Only by paying. But before that, you write a small note. In case if there is any difference, in the debits and credits of the above said entry, we need to accordingly account for the difference. Either as goodwill or as capital reserve. Next, third point, discharge of liquidators of vendor company. What is the entry that you are going to pass liquidators of the vendor company account data to liquidators of vendor company account data to cash to bank to equity share capital to preference share capital to security premium. Security premium. Discharge of liquidation expenses, or otherwise you can write it as payment of liquidation expenses. Payment of liquidation expenses of the vendor company by the purchasing company. What is the entry? Goodwill oblique capital reserve account data to goodwill oblique capital reserve account data to cash oblique bank. Friends, try to understand why we are making use of the goodwill or the capital reserve. Point here is, it is whose liquidation expenses? It is the vendor company's liquidation expenses. So in the purchasing company, I cannot account for them as liquidation expenses, and I cannot close the same against the profit and loss account of the purchasing company. So naturally, paying the liquidation expenses of vendor company means what? You are paying apart from the purchase consideration extra this liquidation expenses. That means indirectly you are increasing the purchase consideration. Once you increase the purchase consideration, the difference between the purchase consideration and the net assets taken over will get increased, and once that is going to get increased, what it is to be treated as? Goodwill. Of course, if you have got capital reserve, then all the capital losses must be closed against the capital profits. So in that case, we want you to debit the capital reserve account. Other way around, it is a capital loss only. So on that pretext, we are asking you to debit the goodwill account. Or other way around also, even if you think liquidation expenses are met by the purchasing company, that results in what? Reduction in the net assets taken over. So reduction in the net assets taken over, once it happens, the difference between the purchase consideration and the net assets taken over is going to get increased. On that pretext also, it's a capital loss. So with this particular logic, whenever the liquidation expenses of the vendor company is met by the purchasing company, either you should debit the goodwill account or you should debit the capital reserve account. Because once capital profit is there, there is no point in debiting the goodwill account, because then it results in what? On one side, on the asset side, you will see the goodwill. On the other side, you are looking at the capital reserve. There is no point in showing through one balance sheet capital loss on one side and capital profit on the other side. Very well, we can net it off. Instead of creating the goodwill and then closing the same against the capital reserve, better all the capital losses once capital reserve is available to close the same against the capital reserve account. This is fundamentally the logic behind it. Then, having completed the journal entry part to close the books of accounts of the vendor company and to incorporate the same into the books of the purchasing company, let us also discuss in this session what is the purchase consideration. Friends, earlier occasion also we discussed the point that after the introduction of the accounting standard 14, the definition of the purchase consideration itself undergone a change. Prior to the introduction of the AS 14, purchase consideration means all what paid by the purchasing company to the different parties of the vendor company, that is shareholders, debenture holders, creditors and towards liquidation expenses. But with introduction of the accounting standard 14 and purchase consideration being defined specifically as the one which is paid only to the shareholders, now all other payments which the purchasing company is making to discharge the debenture holders and liquidation expenses, these all goes to reduce the net assets taken over, and these will not be included in the purchase consideration. Please write down the purchase consideration definition. Purchase consideration is the side heading. As per accounting standard 14, purchase consideration means amount paid by the purchasing company to the shareholders of the vendor company. Note, no other payments made by the purchasing company towards the discharge of debenture holders or to pay for the liquidation expenses should be included in purchase consideration. Next, methods of computation of purchase consideration. Number one, lump sum methods. Number two, net payment method. Number three, net assets method. Number four, intrinsic value methods. Of course, friends, here the point to be noted is intrinsic value method is only an extension of your net assets methods. Now, one after the other you write down. First, lump sum methods. Under this method, lump sum amount of purchase consideration will be specified in the problem itself. Thus, we need not calculate the same separately. Then, net payment methods. Under this method, all the payments to the shareholders are exhaustively specified in the problem. And what we need to do is to add all the payments to arrive at the purchase consideration amount. Next, net assets methods. Net assets methods. In case if the method is neither lump sum method nor net payment method, then we should calculate the purchase consideration under net assets methods. Friends, here you need to keep in your mind, need not write it. Generally, when we go to the net assets method, in case if a few of the payments are given in the problem and it is stated in the problem that balance will be paid in cash, how you will be knowing what is the balance to be paid in cash? First, you will see what is the net assets taken over. From that, payments which are defined you are going to reduce, so that what is the balance to be paid in cash will be known. So, only in situation where lump sum method is not applicable and all the payments are not exhaustively defined, you go to the net assets method, or where the problem specifically asks you to calculate the purchase consideration under the net assets method. So, under this method, what you are going to do? Write down. Purchase consideration is equal to net assets taken over, is equal to net assets taken over. That is, assets at their taken over values less liabilities at their taken over values. Then next method is intrinsic value methods. Intrinsic value methods. Friends, as I already explained, intrinsic value method is only an extension of the net assets method. And here the problem will say that purchase consideration is to be calculated based on the intrinsic value of the shares of both the companies. If that is the case, what you will do? How do you get the intrinsic value? How do you get the intrinsic value is, what you will do is, what is the net assets of the vendor company you are going to see. Similarly, you are going to look at what is the net assets value of the purchasing company. Net asset value of the purchasing company will be divided with the number of shares of the purchasing company, so that intrinsic value of the per share of the purchasing company will be known. Then for the net assets taken over from the vendor company, how many number of shares are to be issued by the purchasing company means what? Net assets taken over from the vendor company by the purchasing company divided by intrinsic value per share of purchasing company. So, write down the point. We need to calculate net asset value of both vendor company and the purchasing company. Vendor company and the purchasing company. Then intrinsic value per share of purchasing company is equal to intrinsic value per share of purchasing company is equal to net assets value of purchasing company, net asset value of purchasing company divided by number of equity shares of purchasing company. Number of shares of purchasing company. This will give you what? Intrinsic value per share of the purchasing company. Then number of shares to be issued number of shares to be issued by the purchasing company is equal to net assets value of vendor company, net asset value of vendor company divided by intrinsic value per share of purchasing company. With this, we covered so far accounting in the books of vendor company, that is for its closure, incorporation into the purchasing company, the assets and liabilities of the vendor company being taken over by the purchasing company, and what is purchase consideration and what are the different methods of calculation of the purchase consideration. We will do in the next session 5 to 6 problems on the concept, theoretical concept that we studied so far. Thank you.